This question tests the financial decision of whether to borrow from a bank to take advantage of a supplier's cash discount. In working capital management, companies should compare the cost of bank borrowing with the benefit of obtaining the trade discount. If the borrowing cost is lower than the savings from the discount, borrowing is financially beneficial. Dexter purchases $25,000 of merchandise twice each month, so it purchases $50,000 per month, or $600,000 per year. The supplier offers terms of 1/15, net 45, meaning Dexter can receive a 1% discount if payment is made within 15 days instead of waiting until 45 days. By paying early, Dexter saves 1% of its annual purchases, which equals $6,000 per year. However, to pay 30 days earlier, the company must borrow funds from the bank. The average amount borrowed over the year results in an annual interest cost of approximately $4,950. Therefore, the net benefit equals the discount savings minus the borrowing cost. Discount savings, $6,000 interest cost, $4,950 net annual savings, $1,050. Thus, borrowing to obtain the discount increases shareholder value. A. $525. Incorrect. This understates the net savings and reflects an incorrect estimate of the financing cost or discount benefit. B. $1,050. Correct. The annual trade discount savings exceed the interest paid on the bank loan by $1,050, making borrowing the better financial decision. C. $1,575. Incorrect. This overstates the benefit by understating the borrowing cost. D. $2,250. Incorrect. This ignores a significant portion of the financing cost associated with paying suppliers earlier. Correct answer. B. $1,050. Exam tip. When evaluating cash discounts versus bank borrowing, compare the annual discount savings with the annual interest cost of financing the early payment. If the borrowing cost is lower than the discount earned, taking the discount is the financially superior choice. This question tests cash management decisions, specifically whether a company should adopt various techniques that speed cash flow or improve cash management. The key principle is straightforward. A cash management technique should be adopted only if its monthly benefits exceed its monthly costs. Students should evaluate each proposal individually by comparing the monthly interest savings, or additional earnings, with the monthly service cost. No complex formulas are required. Simply compare costs and benefits. Lockbox system. The monthly cost is 170 banks times $25 equals $4,250. While monthly interest savings are $5,240. Since the savings exceed the cost, this proposal should be adopted. Drafts. The company would process 4,000 refunds at $2 each, resulting in a monthly cost of $8,000, while interest savings are only $6,500. Because the cost exceeds the benefit, this proposal should not be adopted. Bank float. The bank charges 2% of $1 million, or $20,000, while the company earns $22,000 in interest. The net monthly benefit is positive, so this proposal should be adopted. Electronic transfer. The cost is 700 transfers times $18 equals $12,600, while additional interest earnings are $14,000, producing a positive net benefit. A. A lockbox and electronic transfer only. Incorrect. This ignores the positive net benefit from the bank float arrangement. B. Bank float and electronic transfer only. Incorrect. This excludes the lockbox system, which also provides positive net savings. C. Lockbox, drafts, and electronic transfer only. Incorrect. Drafts should not be adopted because their monthly cost exceeds the monthly interest savings. D. Lockbox, bank float, and electronic transfer only. Correct. These three alternatives each produce net positive monthly savings, while drafts do not. Correct answer: D. Lockbox, bank float, and electronic transfer only. Exam tip: for cash management questions, simply compare the cash savings with the implementation cost. Adopt only those alternatives where the financial benefit exceeds the cost, and reject those with negative net savings. This question tests cash management and the decision between using a wire transfer and a depository transfer check, DTC. The objective is to determine when the higher cost of a wire transfer is justified by the interest earned from receiving funds sooner. The important facts are: a wire transfer costs $12 and makes funds available immediately. A DTC costs $1.50 but delays the availability of funds by 2 days. The company's short-term financing cost is 9% per year, meaning earlier access to cash generates financing savings. 360-day year is used. The additional cost of choosing a wire transfer instead of a DTC is $12 minus $1.50 equals $10.50. The company should use the wire transfer only if the interest savings from having the money available 2 days earlier equal or exceed this additional $10.50 cost. Using the 9% annual financing cost over a 2-day period, the transfer amount required to generate savings of approximately $10.50 is about $21,000. Thus, transfers larger than this amount justify using the faster but more expensive wire transfer. A. $21,000. Correct. At approximately $21,000, the financing savings from receiving funds 2 days earlier offset the additional cost of the wire transfer, making it economically worthwhile. B. $24,000. Incorrect. This amount is higher than necessary. The wire transfer becomes cost-effective before reaching this level. C. $27,000. Incorrect. Although a wire transfer would certainly be beneficial at this amount, it is not the minimum amount required. D. $42,000. Incorrect. This greatly exceeds the threshold at which the wire transfer becomes economically justified. Correct answer: A. $21,000. Exam tip: in cash concentration and transfer decisions, compare the additional transfer cost with the interest savings from receiving cash sooner. The preferred method is the one that minimizes total cash management costs while maximizing the value of available funds. This question tests understanding of zero balance accounts, ZBAs, an important cash management technique used to improve liquidity and control cash balances. Under a ZBA system, a company maintains several operating accounts that are kept at zero or near zero balances. Funds are automatically transferred from a central concentration account only when checks or other payments are presented for payment. The primary objective of a ZBA is to minimize idle cash balances while maintaining sufficient funds to meet payment obligations. By centralizing cash management, companies can reduce unnecessary balances in multiple bank accounts, improve investment of excess cash, and simplify treasury operations. The question asks which item is not typically reduced by implementing a ZBA. Students should recognize that while ZBAs reduce excess cash balances and improve administrative efficiency, they do not reduce disbursement float. In fact, companies often seek to maintain or maximize disbursement float, allowing cash to remain invested until payments actually clear the banking system. A. The cost of cash management. Incorrect. ZBAs generally lower cash management costs by reducing idle funds and improving centralized cash control. B. The disbursement float. Correct. A ZBA does not typically reduce disbursement float. Instead, companies often preserve available float until payments are processed, making this the exception. C. Excess bank balances. Incorrect. One of the main benefits of a ZBA is minimizing unnecessary balances held in multiple operating accounts. D. Management time. Incorrect. Automated transfers and centralized cash control reduce administrative effort and improve treasury efficiency. Correct answer. B. The disbursement float. Exam tip. A zero-balance account is designed to reduce idle cash and simplify cash management by funding operating accounts only when needed. It reduces excess balances and administrative costs, but it does not eliminate payment float, since checks still require time to clear through the banking system. Understanding the distinction between cash concentration and float management is essential for working capital management questions.